1 in 5 U.S. hotel loans may default through next year, according to our next guest. Ken Rosen says hotels will have the highest foreclosure rate of any in the sector. Rosen runs a real estate hedge fund with more than $300 million in assets. He is also the chairman of the University of California's Fisher Center for Real Estate and Urban Economics. Ken, glad to have you on the program. If you had to pick one factor, the one that's weighing the most right now on your space, is it falling room rates? Is it tumbling property values? A dormant securitized mortgage market? Can you pick just one?
I think the most important thing is the Great Recession, the fact that we have lost so many jobs that corporations and individuals are cutting back on travel. So falling room rates and occupancies, there's something called RevPAR, revenue per available room, which is down between 20 and 30% year over year, and that is worse than even during the period following 9/11.
Could as many as a third of the $8.5 billion worth of securities backed by hotel loans, we're just looking at ones due 2010, be at risk of default? I mean, that sounds pretty aggressive, a third.
It is a big number, but as I said, the cash flows declined dramatically. And I'm afraid 2010 may be just as bad a year because many of the conventions and advanced bookings are down dramatically. And this decline is a worldwide phenomenon. It's not just the U.S., it's everywhere. In the U.S., we have one more thing going on, a new Puritanism where there's been a lot of people talking about high-end hotels. You shouldn't have conferences and meetings there. But that's a bad thing, I think, because most of the people working at hotels are low-end workers, and it's a bigger industry than the auto industry.
Ken, Barclays Capital downgraded hotel stocks today because of what you're alluding to here, increasing foreclosures, potential bankruptcies. Two of the names in their call, Starwood, that trades under the ticker HOT, and Marriott, MAR. As part of your hedge fund, are you moving any money around calls of a similar nature, maybe what you think about those two companies?
Well, we can't talk about individual names, but we really think the hotel sector is going to be under pressure continually for the next year, unfortunately, because it is such an important industry. But it is a function primarily of the Great Recession. And until we get jobs created and people feeling more confident in the economy, hotel bookings are going to remain very, very weak.
Some economists are actually looking for a positive third-quarter GDP. You're speaking about the larger pressure, the macro pressure. If the U.S. economy does show growth in the third quarter, does that change at all your outlook? Make you a little bit more optimistic?
No, I think real estate is a lagged indicator, and commercial real estate, and hotel bookings, a good chunk of them are done in advance, and the data does not look good for the next 6 to 9 months. So I don't think a positive GDP number will mean much. The economy is still extremely weak. We're maybe not near a depression any longer, but we're in a Great Recession that's moderating. But the rate of job decline continues to be very severe, and I don't expect any real recovery in the economy until the middle of 2010.
Ken, you alluded to the luxury part of the hotel sector earlier in a different context, but I'm just curious, do you think a company like Ritz-Carlton, for example, Four Seasons, a chain like Four Seasons, is getting hit as hard as some of the other ones we mentioned, for example, Marriott?
Yeah, so the high end has been hit worse than any other sector. There's data on this by sector. The high end has been hit worse because of corporate cutbacks and the perception that luxury is a bad thing in the corporate world. Not that it is a bad thing, because remember, most of those workers are low-income workers and moderate-income workers. And so it's really a shame we're having this puritanical view of the world coming out of Washington. But I think that will change. We're all in this together, and we want to come out of this together. But right now, the high end has been hurt worse than any other sector in the marketplace.
So let's talk about worst-case scenario. Let's say if a hotel is foreclosed upon, what are the chances that that business continues to operate, or does it just shut down altogether?
It almost surely continues to operate. What you do is restructure the loan, have some sort of workout. There might be a debt for equity swap. But certainly the individual hotels will continue to operate. Most of the chain hotels, remember, don't own the real estate itself. They operate the real estate. So it will continue to operate, though might be a new owner come in at a much lower price per room. But these almost always continue, unless it's in a bad location. But these will always continue, but just at different ownership, possibly.
Ken, I'm looking for a bright spot here to leave us on. What are the chances that you could see troubled lenders or troubled companies work out new terms with lenders?
I think that's a very distinct possibility. Every lender would rather not foreclose. They'd rather extend the loan. They'd like to work out the deal. But hotels, because there are no leases, they're one day, every day is a new day, the drop in occupancy and cash flow is putting a lot of pressure on the entire sector. So they're harder to work out than other sectors of the real estate market.
Ken, we thank you very much for your time. Ken Rosen, chairman of the University of California's Fisher Center for Real Estate and Urban Economics, based in Berkeley.